lot of things about Sensex and Nifty all our lives. Sensex is 5% down, Nifty is 7% up, and as a kid, most of us have always wondered what it really meant. Now, it's really important for us to understand Sensex and Nifty in detail before we start moving to the core of our course. So, in today's class, we'll talk about index, also known as indices, and gradually move towards Sensex and Nifty, and we'll talk about how to monitor them. So, let's start with index. A stock market index comprises of a pool of companies clubbed together under certain parameters. A stock market index is nothing but a statistical measure which shows changes taking place in the stock market. Now, the criteria of pooling these stocks together into an index could be the type of industry, market capitalization, or the size of the company. And the value of the stock market index is computed using values of the underlying stocks. Any change taking place in the underlying stock prices impact the overall value of the index. So let's say for an example, if the prices of most of the underlying stocks rise, then the index will rise and vice versa. In this way, a stock index actually reflects the overall sentiment of the market. Now let's have a look at some of the most notable indices in India. Number 1. Benchmark indices like the Nifty index from NSE and Sensex index from BSE. Now, as I told you in the last class as well, Sensex and Nifty are benchmarks comprising of top 30 and 50 companies of our country. They are used as a barometer to check the mood of the market. For example, if the Nifty is down, you find that topmost companies of India are not doing well at that given time. Number 2. Broad-based indices like Nifty 100 and BSE 100. These indices represent the top 100 companies of Nifty and BSE. Number 3. Indices based on market capitalization like the BSE small cap and BSE mid cap. Now, I have already told you about the different market caps in the last video, so I hope you guys haven't forgotten it yet. In case you haven't seen the last video, you can click on the I button to watch it now. Number 4. Sectorial indices like Nifty FMCG index or Nifty Bank index. So they basically represent a particular sector. Like for example, Nifty FMCG index will comprise of FMCG stocks like Nestle, Hindustan Unilever, ITC, Britannia, Marico, Dabur, etc. Now a natural question that will come to your mind is, Srijan, why are stock indices required if you can directly invest into stocks of companies like Reliance, TCS, Britannia and earn exponential returns? See, there are many reasons as to why the index is made. Let's talk about the most important ones today. Number 1. The indices help in stock picking. In a share market, you would see thousands of companies listed on the exchange. Broadly, picking the appropriate stock for investment may naturally seem like a nightmare. Without a benchmark, sorting the stock becomes a challenge. In this situation, a stock market index acts like an instant differentiator. It classifies the company based on their size, sector, industry type, and so on. Moreover, you can also invest into certain sectors directly if you're not sure about a specific company but you're bullish about the sector as a whole. For example, post COVID, millions of investors switched to pharma index because they saw an opportunity in the pharma industry and they made 5 to 10 times return on equity just within an year. Number 2. The parameter for peer comparison. Before including a stock in your portfolio, you have to assess whether it's worth the money. By comparing with the underlying index, you can easily judge the performance of a stock. If the stock gives higher return than the index, it is said to have outperformed the index. If it gives lower returns, then it's said to have underperformed the index. Like for example, if we talk about Britannia, then we'll compare the Britannia stock with the FMCG index. If the Britannia stock has done fairly well in comparison to the FMCG index, then we can say it has outperformed the index. Number 3. It helps in passive investments. Investors who don't want to spend their time learning about the stocks can choose to directly invest into an index fund. Their returns will resemble to that of an index. So, for example, if an investor's portfolio resembles the Sensex, then his portfolio is going to deliver returns of around 8% when the Sensex earns 8% returns. Now let's move to the two most important indices of our country. Number 1. Sensex, which is also known as BSE 30, is the market index consisting of top 30 well established and financially sounded companies listed on the Bombay Stock Exchange. Sensex was started way back in 1978 and the base value of index was 100 rupees. Now, if the Sensex goes down, this tells you that the stock price of most of the major stocks on BSE has gone down. And if the Sensex goes up, it means that most of the major stocks in BSE went up during the given period. So for example, suppose the Sensex is 49130 as I speak today on 26th of March 2021. Now if the Sensex drops to 48450 tomorrow, it means that the majority of the 30 companies are not performing good. That is, their share price is falling. Number 2. Nifty or Nifty 50. So Nifty is a market index which consists of top 50 companies of India. It is listed on the National Stock Exchange. So Nifty was started way back in 1995 and the base value was taken rupees 1000. Nowadays Nifty trades at around 15,000. So you see these companies in both Nifty and Sensex, they are selected on the basis of market capitalization. Now let's try to understand what exactly does this movement across Nifty and Sensex means. As I told you, Sensex and Nifty are both indicators of market movement. If the Sensex or Nifty goes up, it means that most of the stocks in India went up during the given period. The same is true in the case of Sensex as well. Moreover, when Sensex or Nifty goes high, it shows the economic growth of the country. Else, if it keeps declining, it means a slowdown or depression or a recession in the economy. For example, during the Indian recession of 2008-9, the Sensex fell over 12,000 points, around 60%. The fall in the Sensex was in line with the recession, meaning people were selling their shares and an economic crisis was there in the country. Similarly, during the COVID-19 pandemic, the market crashed over 33% just within a month, and which was again in relation to the declining economic scenario in India and the world. So yeah, we can conclude that index funds such as Sensex and Nifty in a way represent our economy and who we are as consumers. We will talk about how one can invest into these funds in the upcoming classes. So summarizing what we have learned today, the market indices are nothing but the barometer for market behavior. It gives a general idea about whether most of the stocks have gone up or come down in a given period. Sensex and Nifty are the most popular market indices which reflects the overall market sentiments. Market indices are used for sorting sectors in stocks for investment purposes. They're also used as a tool for passive investments. A country's major indices are a reflection of how their economy is doing in general. Now, as always, I'd like to end the video by giving you a call to action. Go on Google and search Nifty 50 companies and see how many of those you already knew and you see around yourself from morning to evening every day. You can also comment your favorite stock and company name in case you already have a good understanding of Nifty 50 and Sensex stocks. So that's it guys. वीडियो अगर अच्छा लगा तो लाइक कर देना और हमारे चैनल को सब्सक्राइब भी कर देना. Basically, this video is a part of the basic stock market course that we have created. You can click on the I button to watch our other videos as well. So thank you guys for watching the video. This is Srijan Barnawal signing off until we meet again.